Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, back again. Apologies to our listeners if you're hearing our teeth chattering. It is freezing in Melbourne.
We're recording this on the 1st of June, just to put some context around it. First day of winter, and I tell you what, it's come with an absolute blast. So we're absolutely freezing and hugging our coffees nice and tight to try and warm up our hands, that's for sure.
I'm happy you said coffees and didn't say that we were hugging, but at least we're starting off with a lie for the listeners.
That's it. So something that's fairly fitting for this time of year. We'll be talking today about tax time, end of year tax tips, things that you should be considering just to try and get, maximise your position between the opportunity that presents itself before the end of the financial year. A lot of people will be thinking about tax, their tax return, what that looks like. So we thought we'd talk through a few of those things to try and create a little bit more benefit and try and get a bit more either back from the tax man or try and shape your circumstance a bit so you get an advantage from it.
Yeah, exactly. So today's episode really is just all about those end of financial year tips, the preparation towards end of financial year and sort of trying to, get ahead of it and make sure that you're not scrambling on the 30th of June trying to make those final adjustments on the last day of the tax year.
It's always interesting when that happens. You should be doing your tax planning nice and early, but you don't want to be leaving it too late just in case there's things that you need to do. It takes time to move money around. It takes time to deposit things in bits and pieces. But yeah, I've been caught out like that before. So you want to start as early as you possibly can so you don't get caught out.
Yeah. So what we're talking about is tax planning for the 2022-2023 financial year today. I'm only joking.
It's definitely the 21-22 financial year, just in case anyone didn't understand that. So we're talking about the opportunity that presents itself now before the end of the financial year.
Yeah, exactly.
Andrew, run us into it. What's the first one that we're talking about?
Yeah, first one, and I dare say probably the most obvious one is those concessional or pre-tax contributions towards superannuation. So if there's surplus cash flow, if there's surplus savings in your bank account, one of the considerations or one big tax advantage is to put some, personal contributions or salary sacrifice contributions into superannuation. So the impact that that's going to have is obviously that will reduce your assessable income. As a result, you're paying 15% tax on the way into superannuation. So if you're at 32%, 37.5%, all the way up to top marginal tax rates, by putting additional funds towards superannuation, you're basically getting a tax saving from day one. The other sort of aspect of that, so obviously we've got the $27,500 that's available as a concessional contribution limit. But in addition to that, also consider the unused concessional contributions. So your ability to, look back all the way to the 2018-19 financial year and make sure that you can maximize that as much as you can and help reduce the tax associated.
Yeah, that's a really big one, Andrew, because if you're going back to 18-19 and you haven't maximized those caps, there could be a lot of money available there. And if you put a large amount into superannuation, you can really drive down your assessable income in regards to that. So yeah, that's definitely a worthwhile strategy to look at. One of the other things that is often, overlooked, it used to be a lot bigger of a benefit back in the day, but the government co-contribution is still available. So essentially it's designed for low and middle income earners to beef up their superannuation balance. And there is an incentive from the government. They used to match and actually give more money than your contribution. But essentially, if you earn less than $41,000 and you put $1,000 into superannuation, the government will match that at a rate of 50 cents up to a $500 benefit. So it's a really good opportunity if the household has got some surplus income to be able to put that in to try and get the 50-cent benefit from the government.
Yeah. And just to confirm, that's an after-tax contribution. So what we're talking about is a non-concessional contribution that you need to make in order to receive that.
Yep.
And I dare say, look, I know we're talking, $1,000 and $500, which ultimately may not sound like a huge amount of money, but you tell me an investment that will deliver a 50% rate of return as at day one, which is essentially what it is. You put $1,000 in and you're getting a 50% return straight back as a result of it. So when you look at it by percentage and when you sort of dwell down on it, and if you can do that over the course of a number of years, it's definitely something that's still pretty substantial.
The government's giving away free money, Andrew. We're not going to say no to that.
Exactly right. It doesn't happen often, so you better take advantage of it when you can.
That's it. I mean, look, it used to be $1.50 for every dollar that you contributed, and then they scaled that back to $1, and now it's 50 cents. So it's still pretty good, but it was much better back in the day. That's for sure.
Back in the day, yeah, exactly. Make sure you make the most of it now, because it'll go down to 25%.
Well, you never know when they're going to get rid of it. Andrew, spouse contributions. Talk to us about that.
Yeah, so another one, again, really, really often overlooked. But basically, if your spouse is earning up to 40 grand a year, you can put $3,000 into their superannuation. So what you're doing is putting money into their super fund as opposed to your own. And the tax offset that you can claim on that is up to a maximum benefit of $540. So in essence, what you're doing is you're putting money towards your spouse's superannuation. If you put $3,000, they're earning less than $40,000. That's the income threshold in order for you to be eligible for it. You can get up to $540 as a tax offset. So again, I mean, you enact a couple of these strategies and all of a sudden you're talking about decent sum of money.
Yep. And another, I guess, one that's probably overlooked and not really thought about. But yeah, once again, really easy if you're in that criteria and you've got the cash flow to do it. Real easy to get a little bit of extra back from the government, that's for sure.
And I'd even say, I mean, with all of this stuff, what you want to be doing is, yeah, of course, this year you want to make the most of it. But if this is something that you want to embark on, plan for it. You know your circumstances, very likely you know what, or have an idea as to what your income's going to be. Make sure that you plan for it. Make sure that you put money aside. Don't wait until the end of financial year, next year to just come up with the money required in order to make the contributions. Put a savings aside in order to make sure that you can stick to this strategy next financial year. So looking forward, make sure that you're not just making the most of the surplus cash that you have. Probably a little bit too hard to plan for it a month before end of financial year now, but definitely plan for it in future years.
No, well said. Another one that's on the radar, not necessarily from a tax minimization perspective, but just more so from a planning point of view. I mean, in previous podcasts, we've spoken about contributions into super, especially in relation to the superannuation caps, but the non-concessional contribution cap, so that's where you're making an after-tax deduction into superannuation. As the cap currently stands, you can make $110,000 each year. So they're for people who are in that position and have the cash flow available and the strategy suits. Doing that this side of the financial year obviously makes sense because you're eliminating the cap that's available to you now. When you tick over to the new year, you lose the previous year's ability to do that. So depending on your circumstances, depending on your situation, considering your non-concessional contribution into superannuation could definitely be something that you consider at this particular time of year.
Yeah. And look, have a look at timing as well. So the timing of it can make a fairly substantial difference. So just taking an example, if you want to put $440,000 towards superannuation because you're either just about to retire or you're wanting to put money towards a tax-free environment, or you're planning early and you've got the cash and money to do so. If you make a non-concessional contribution now and you utilize the bring forward rule, you can do $330,000 towards superannuation, but you can't contribute for the next 2 financial years. However, if you can time it correctly and do $110,000 on this side of the financial year, you've done 110, and then as soon as the financial year ticks over, then you utilize the bring forward rule and do another $330,000. All of a sudden, rather than only being able to contribute $330,000, you've now done $440,000. So if part of your strategy is maximizing the amount that you can get into superannuation, that's one of the ways to dramatically increase that.
That's one of the other things that's really important and critical as well too is when you make these contributions, you need to leave enough time for the superannuation fund itself to process the transaction. They get very busy at this time of year because everybody's considering adding money to super as part of their end of year tax planning. So you want to do it earlier in the month if you can and make sure that you're leaving enough time for the super fund to process that, because it's not when you make the deposit It's actually when they receive it and process it. So if you get too close to the end of June and they've got a backlog with, processing transactions, it may actually fall over into July, and then you've obviously lost that opportunity. So that's just something that you need to be mindful of. If you're going to do it, make sure you leave yourself and the super fund enough time to be able to process the transaction, because you don't want to put all of this time, effort and energy into and making the commitment to putting money into super, and then all of a sudden it tips over into the next thing and that changes everything altogether.
Yeah, you've reached contribution limits, whole myriad of other issues.
Happens every year.
Yep. Exactly. Next one, which is also, it's a cautionary tale as well, but if you've got some large deductible expenses that you expect are, going to fall due irrespective, trying to claim it on this side of the financial year. So trying to pay for those large expenses on this side of the financial year means that you get the tax return and the tax deductibility of it in this tax return, as opposed to claiming it a month later and all of a sudden you need to wait all the way until next financial year in order to claim the tax back on that. Now, I say a cautionary tale because obviously you want to maximize your tax deductions. Obviously you want to, claim them as soon as possible. And especially if it's something that's large in nature, you'd prefer to claim it on the earlier tax year. But one of the things that we've seen happen a million times is you're overpaying for deductible expenses just so that you can get the deduction. It's so common, and so many people try to just buy things for the sake of claiming it as a tax deduction. You're only claiming your taxable income portion back, so you're still paying for the item. So when I say claim those larger expenses this financial year, claim those larger expenses that you're going to incur anyway. Don't overspend just so that you can claim a tax deduction. That is just crazy.
I always found that an interesting one, Andrew, because people do chase that at times, and it never really made sense to me, both in a business sense and also mathematically as well too. But you hit the nail on the head. If you're going to spend that money, consider doing it this side of the year, but don't spend extra just because you're chasing the tax deduction. That makes perfect sense. I guess for our small business owners as well too, one of the things to take into consideration is if there's any equipment that you need to purchase, consider doing it at this side of the financial year. Depending on what it is, you may be able to write that down in this financial year in its entirety. It's probably a question and a consideration for your accountant. That could also be something that you tend to look at as well too. But worthwhile strategy, and I think a lot of small businesses look at that and see what they can bring forward with the understanding that they're going to be purchasing or spending that money anyway. So one of the other things that probably isn't as well known unless you're in this category, but for people with margin loans, so they've got an investment, they're obviously borrowing and leveraging in order to run that investment and put money into it. But with a lot of the margin loan providers, they'll actually let you prepay the next year's interest in advance. So that will obviously help you in this tax year, but you're prepaying for next year's tax bill. So that could also be a consideration for people as well. If they, one, have the cash flow, and two, wanted to get the deduction in this financial year, that could also be a consideration as well too. Obviously, the higher the loan and the higher the interest rate, the bigger the benefit's going to be, in conjunction with the higher the marginal tax rate that you're on. But that's also a consideration for clients who have a margin lending facility.
Yeah, exactly. The other one takes a little bit more planning, and especially when you're talking about something like a capital gain, because a lot of the times it's something that is likely to happen or is going to happen in advance. But if you're making a substantial capital gain, make sure that you obviously use some of the things that we've discussed in order to help try and offset that capital gain, or even try and time it in tax years where your income is lower. So for instance, and a bit of an insight into my personal life, but at the moment, my wife and I are selling an investment property. So we're wanting to sell that property in the next financial year. So not in the 2021-22 financial year, but the 22-23 financial year. And the reason that we're doing that is she's going on maternity leave. She's actually pregnant at the moment. So because she's going to be on maternity leave, because she's going to have a drop in income, we'd rather the capital gain be encapsulated in the next financial year as opposed to this financial year, in order to minimize the tax that's associated with it. So if you're going to make a capital gain, if you're going to liquidate an asset, if you're going to do something for a specific purpose, A, try and claim the tax offsets against that capital gain so that you're reducing the tax, and B, try to see if you can maneuver it in a tax year where your income's going to be lower in order to, again, help reduce the tax that's associated with it.
Worthwhile strategy if you can time it, absolutely. One of the other ones that's probably really critical at this time as well too, and it probably impacts more of us now than it has traditionally in the past, but you could always claim working from home expenses. There's a couple of different methods that the ATO allow you to use. It's the fixed method, which they just apportion a certain amount of cents per hour. There's the actual method where you can actually calculate it to the nth degree. And once again, this will depend on, I guess, your appetite, how well your record keeping is, and also the appetite of your accountant. But the one that's sort of sparked my interest is the shortcut method. And that's just something that's been brought in temporarily, and it finishes this financial year. It's been brought in temporarily because the government knows that a large portion of the population was working from home during COVID. So that allows us to just apply a cents per hour rate, essentially right across the board, to try and make this whole process a lot easier. And what they're trying to do is that they understand that people were incurring expenses from working from home. They want to try and alleviate the burden of needing to calculate it to the nth degree to try and get cents in the dollar in terms of what they're going to claim, because then it wastes, obviously, the individual's time, it wastes the accountant's time. So they have created this, definitely worth looking at. But when you are going through that tax planning with your accountant, definitely talk to them about that, and they will advise you on which method that you should be using.
Yeah, absolutely. Absolutely. Something that we've not never had to, but hasn't been very prevalent in the past. But now all of a sudden it seems like everyone's working from home, or at least doing some sort of partial work from home over the course of the last couple of years, especially if you've been lucky enough to be in an industry where you can do that. So yeah, definitely have a look at that.
I guess the other thing from that too, Andrew, I mean, that cents per hour method is more so about the stuff that you consume: electricity, heating, the space that you use for your office, internet, mobile phone, so on and so forth. The other thing that we should mention as well to talk to your accountant about is if you've purchased any equipment, what does that look like as well too? You know, I know a lot of people have bought furniture, a second monitor, another keyboard, whatever it may be. Talk to your accountant about that too, because you should be able to claim a tax deduction on the equipment that you've purchased for work as well.
Yeah, absolutely. Absolutely. Next one, which is a little bit of a change from the tax side of things, because it's less of a tax and it may result in a tax saving if you're planning for it correctly, but a really important time of year to review your budget. So if you've set a budget for yourself for the financial year, really good time to look at, okay, how much did I actually spend? Am I on track? Am I not on track? Did I do what I thought that I would? Do I need to review my budget for the next year? So look at, okay, what am I going to do in the next financial year? Is it going to be a method of we're going to maintain the same budget in the next financial year? Does there need to be a review of your budget? So look at your cash flow planning, your budgeting, all of that stuff for the next financial year as this financial year comes to a close, and review how you did in the last 12 months. Did you stick to it? Did you not stick to it? Or the reasons? What can you do in order to make sure that you do and it works more effectively in the next financial year?
Yeah, and that one's really critical, not only at this time of year, that obviously makes sense, but we're in a high inflation environment. And I don't know about you guys, but every time I seem to go anywhere, I'm paying more and more money for it. So just in light of that, I think it's a good exercise to do anyway. But once again, incorporating that with your tax planning and, looking forward for next year, definitely the way to go in relation to your budgeting and your cash flow, no doubt about it.
Yeah, and I like doing it at this time of the year. I mean, generally most people, you don't have to. I mean, some people can do it. You can say February is the month that I'm doing it, or March is the month that I'm doing it. But I just find end of year is such a busy time with breakup parties from work, with New Year's and Christmas and all of that stuff, that if you're doing it on calendar year, it can become really easy for that to slip away from you. Whereas financial year, especially when we're talking about financial year in Australia and Melbourne, it's cold, freezing, teeth are chattering. You don't feel as guilty to sit behind your laptop or sit behind your computer or pen and paper or whatever method you use and look at your budget, because there's less happening. You've sort of got a bit more time to look at it and spend a bit more time on it as well.
Yep. Well said. Well summarized. Andrew, probably one last thing I think we need to talk about. We don't need to spend a huge amount of time on it because I don't love the space, but in terms of capital gains and capital losses, because we've seen a lot of movement in this space, is crypto. It's becoming more and more popular. I think people are getting more and more exposure to it. But just something to point out that people may not know is when you're transferring fiat currency, so say Australian dollars, into your crypto wallet and you buy a coin, it's not when you're taking the cash out that captures the capital gain. It's actually when you're transacting. So what I mean by that is, say you put $1,000 into your wallet of Australian dollars and you buy Bitcoin, and that Bitcoin has gone up to $1,200, and so you've made a $200 hypothetical gain, and you move that to Ethereum. That transfer of the $1,200 is the transaction that the capital gain is determined on. So you bought in for $1,000 and then you sold out, or you didn't really sell out, you swapped to Ethereum for $1,200. So you've got a $200 capital gain. So swapping between coins triggers an event as well too, especially for those people that are, I guess, trading crypto and it's happening very, very quickly. Your record keeping needs to be very, very tight because swapping from one coin to another, and I know people that are doing hundreds of transactions a day, that can trigger capital gain or a capital loss as well too. So just something to point out. It's not Australian dollars in versus Australian dollars out, or money in versus money out. It's actually the transaction between the coins as well too.
And when we're talking about a volatile environment, or when you're talking about an asset planning for it, is really important, because in that same example, let's say you've put $1,000 in, it's become $1,200, you've transferred it to Ethereum, now that's worth $1,200, or at the time of purchasing, that's worth $1,200, and it's still invested in Ethereum. You've made $200 capital gain, and let's say Ethereum drops to, $200. Now, all of a sudden, you've got a capital gain of $200 that you need to pay, and you've got an asset that's only worth $200. So all of a sudden, you're either forced out of cash flow to fund the capital gain, or alternatively, you're forced to sell an asset that you don't necessarily want to be selling in order to fund that capital gain. So make sure that you're planning for it, make sure that your record keeping is tight. And this is not based on any knowledge other than my own speculation, but I dare say this is something that the ATO will probably be keeping a very close eye on. It's something that hasn't necessarily formed part of what they've been looking at in the past. And so naturally, as something new comes into the market, it becomes an area of focus. And so making sure that your record keeping is really up to scratch is imperative.
Yeah, it is. It's becoming a larger focus of the ATO. Their record keeping or record matching is getting better and better as well too. And the other thing is they have the mandate to go back as far as they want. So we could fast forward 3, 4, 5 years. The technology that they've got available becomes much better, so they can go back to previous years and check the data. And if that's the case, absolutely, those people that haven't declared it, it's only a matter of time, in my opinion.
Yeah, exactly right.
Andrew, I think probably the last message from us is it's an opportune time at this point of the year. Bit of tax planning, bit of tax minimisation if possible. Definitely, like we always say, get advice, speak to your accountant, speak to your tax advisor. Always a good idea. See what options are available to you. Speak to your financial planner as well too. Really critical time. We've got, at day of recording, we've got 30 days left. So speak to your advisors and see what they say.
Exactly right. And look at, review not just, yes, your tax in this financial year, but plan ahead for the next financial year. Review your business structure. If you've, set up a business, if you've set up a side hustle or, whatever you want to call it, review what's the structure of it. Is it in the most appropriate way? Making sure that you're engaging with your tax advisors, with your financial advisors, you're really getting a holistic view of what implications are of any changes or decisions that you're making. But make sure that you're maximizing the tax deductions and what you can get out this financial year, and make sure that you're planning and looking ahead for what comes in the next financial year, because it comes quickly. I can't believe we're already talking about end of financial year. It feels like only a month ago that we were speaking about it last financial year.
Time flies when you're having fun, Andrew.
Exactly right.
And on that note, thank you. And thank you to our listeners for your attention. Hopefully you got a whole heap of information out of today's podcast. As always, if you want to reach out or need any further information, details are in the show notes. Thanks for your time, Andrew, and we'll catch you guys on the next one.
Yeah, Bills, thanks for your time, and thanks again to all the listeners.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.